Welcome to PhillipCapital's Weekly Market Watch. A global boom in the cost of commodities entered its sixth year with no end in sight in the beginning of 2009. However, as major economic powers sank into recession, concerns over the sustainability of demand drove commodities sharply lower. This asset class has since recovered some lost ground. As such, it is a good time to revisit this asset class and question if this rally is sustainable. So Hilary, how has commodities performed recently?
This asset class has recovered as much as 10% from a low of 200 measured by the Commodities Research Bureau Index. Among the various forms of commodities, metals performed the best. The Dow AIG Industrial Metal Index gained approximately 11% in March. Copper was the best performing contract. Year to date, it gained as much as 33%. Other commodities that have performed well include gasoline and silver.
Could you elaborate on what could have contributed to the better performance?
The better performance in metal could be attributed to greater demand from China. Increased demand is caused by a stockpiling program spearheaded by the Strategic Reserve Bureau. The Reserve Bureau has been purchasing metals in an attempt to support domestic producers after exports tumbled.
Do you think the rally is sustainable?
For the rally to sustain, there must be an improvement in the level of activities in the market. We believe that commodities are primarily driven by demand factors. This is so as commodities tend to follow the movement in the OECD Composite Leading Indicator. This indicator provides early signals of future economic activities and thus signals the level of demand for commodities. For instance, when the indicator declines, this will imply that activities will be slowing and hence there will be a lesser demand for raw materials.
Has there been an improvement in economic activities?
Manufacturing activities in the States, as measured by the ISM Manufacturing Index, has improved for the third consecutive month. In March, the index stood at 36.3%. It is significantly higher than the reading in December, but still below the watermark 50. Nonetheless, this suggests that activities might be picking up gradually.
Any last words?
Although recent economic data has been upbeat and various governments will most likely continue to implement fiscal policies to lead their economy out of recession, there is a need for more convincing signs of an upturn of global economic growth in order for the commodities rally to sustain.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.